You're listening to Toronto's #1 real estate podcast, powered by Watson Estates. The most successful local real estate investing starts right here, right now. Here's your host, broker, investor, and social media influencer, Bradley Watson.
Good morning, investors. Bradley here from Watson Estates. I hope you guys didn't melt yesterday. Today is supposed to be another beautiful day. And yesterday was our first day back after what seemed like a long time. Really, it was only 4 or 5 days. But to me, that was a long time because I missed you guys. And as I'm seeing the news, I want to make sure I'm sharing it with you and kind of giving my take from within the industry. But yesterday, we got the headlines and I talked way too quick, tried to give you all of the juicy things out there, but today I want to give you the deets. That's short for details, by the way, for all of you older people out there. The deets. We are #1 on Google Podcasts for Toronto real estate. You guys make this an awesome place. We have fun every single day trying to get some of the lighter side of real estate here in Toronto. And when you've got news like this, National Bank of Canada forecasts sharpest real estate prices decline ever. We all need a little bit of fun. You can't just read that with a straight face unless you're in your office. I remember when I used to have an office job, I'd show up to work, we'd have these little newspapers and everyone would have their nose in the newspaper. Do people still read newspapers in offices anymore? I don't know. But they'd have your nose in the newspaper and everybody reading the same articles, and the headlines are just so gloomy. So we're going to have some fun. We're going to share with you what these guys have to say. We're not hiding from the news, but we're having fun with it. And we're also giving a kick in the pants as it goes to reality here and making sure you guys know what's going on a daily basis among real estate professionals and among our industry. So here we go. Here's what we're going to cover today. We're going to start talking about this National Bank thing. Why are they expecting declines from 2020 to 2021? That's been their forecast. Now, the sky isn't falling, as we've seen in the stats, but will it in Q3 and Q4? We're going to answer that. Then, will a commercial eviction freeze help keep businesses open? As you might have heard, this is now a thing. We were kind of predicting it would come, and here it is. Commercial evictions are now here. What is that going to look like, and will it work? And what backlash is coming now from the CMHC's tighter mortgage requirements? We mentioned this yesterday, but I want to dive a little deeper. And what are some of the consequences? Because this is supposed to be rolling out as of July 1st. And so we've got a window here that could mean big things happening in the next 3 weeks. All right. You guys ready? Let's have some fun. So let's start talking about an article. Of course, we got to jump from Better Dwelling. They're the ones that have the strongest readership. And this is the article of the day. It's #1 on Google, at least at the time that I'm recording this podcast. National Bank of Canada forecasts sharpest real estate price decline ever. Woohoo! One of Canada's big 6 banks, National Bank. Is that even a big 6 bank? I guess. You guys could be included. They're joining CMHC and credit risk agencies in forecasting lower prices. Their economists expect real estate prices to make a sharp drop this year. Well, that'll be interesting. Let's see it. The bank is calling that what would be the largest price drop in Canada's history with, listen to this, Toronto and Vancouver hit hardest. We see the highest price increases. When the cards come crumbling down, we see the highest price decreases. But overall, we end up winning. So it's okay. But if this is going to be the year of the house of cards falling, we want to know about it. So I want to look at what are the reasons for it in this article and share with you some of the highlights. And there's no new things in here, by the way. It's just another forecast, but it's good to get a perspective because as we're kind of pulling all of these ideas of what people think are going to happen, and honestly, it's like, is it Joe or Sam, or I guess I got to get a girl's name too, keep it equal here, or Alyssa or Courtney? Courtney. There's a guy in this article we're going to talk about. His name is Courtney. So we're going to go with the girl named Courtney here. So, sorry, that's an insight. You guys don't get that joke because we're not there yet. I'll tell you when we're reading about what Courtney has to say about all this. All right. The bank's forecasting the largest recession drop for real estate prices in Canada's history. Prices are forecasted to fall an average of 9.8. This is across the country from 2020 to 2021. So, where we are now, if we were kind of floating, let's say here in Toronto, we're floating, up 3% year over year. So they're saying it'll come down another 9 into next year. So from last year, that would put you down, 6. But They actually said that it's more because in Toronto, they're saying prices could dip 13% from the end of the year through to next year. So they're not saying it's happening now. They're saying it's going to happen. And of course, Better Dwelling positions them correctly by saying they're on the low end of what CMHC said, but they're below most risk agencies. So there's been more extreme. Of course, there's been more. So they're just saying, oh, by the way, there's worse news out there. Of course, there's worse news. There's also better news. Okay. So wherever they fall, this is what these guys are saying is going to happen. And they're contrasting this against 2008. I didn't realize this. I don't know if I buy this number, but okay, fine. You're the writer here. Prices dropped in 2008 by 6.3%. And during the 81 recession, the largest drop was price drops of 9.2%. I think that the price dropped more than 6% in 2008. Like, that's what my memory is. I swear prices dropped double digits, but they bounced back quickly. There was a bit of a fluctuation, and so it recorded maybe at 6%, but I think it was more. Anyways, regardless, they're saying that this year is going to be the most extreme ever. Time will tell. So here's their reasons for it, okay? This is what you want to take. Regardless of what you think is going to happen, regardless of what the consequences will be on prices, we're all looking at the same data points, and here they are. The biggest contribution to this trend is expected to be unemployment. Okay, and we've talked about this in past podcasts. This is what everybody is monitoring the most. It's not the only thing, but it is one of the big ones. They also see unemployment averaging out at 9% by the end of the year. Okay, so that's what these guys are predicting. Now, as you're predicting what is going to happen in house prices, behind that prediction and that forecast is a ton of other predictions. And in this case, there's an unemployment prediction is 9%, right? So this is why forecasts are so wide ranging, and this is also why they're all wrong, because like even if you were right on your final number, the way you got there was definitely wrong. We're all just throwing numbers out here and we're trying to figure it out. So but the big reason here is unemployment, and it is obviously a factor that's going to hinder the purchasing power of Canadians, including the Toronto real estate market. This is lower than most other bank forecasts, but still high enough for a recessionary environment by itself. So they're saying that actually their employment numbers are actually not as bad as some of the banks. Canada doesn't have a plan, so this is where it ultimately goes down to as well. And I like how they kind of lined it up. So it's not just this and that. Like, we've looked at unemployment and immigration, okay, which is where we're going right here. They're actually saying they're one in the same. Canada doesn't have a plan to lower immigration. In fact, the government plans to stick to its population growth strategy, which sees mild increases, which a mild increase is definitely not happening this year. From the numbers that I'm seeing, we're still having people coming in, but it's so small, and we were having like 1 million people in less than 3 years. Despite this, the bank's economists note during recessionary periods, immigration voluntarily declines. Duh. Right? So, of course, when you're in a recession, no one wants to travel. I'm going to go search for a better life in a crumbling economy. This trend is observed in all 3 previous recessions and expected to occur in this one. So, of course, unemployment, as well as the travel industry getting a big bang and exploding and disappearing overnight, all of these things are, of course, affecting our immigration. But I think, to give a little bit of lightness to where this is going, what better place would you want to live in the tail end of all of this than right here in Toronto? Some people are probably sitting back thinking, yeah, but you guys didn't reopen on phase 2. Guys, we have an amazing country, and people know it. And when you shake up the global world like this, the global world. Anyways, moving on. You get my point. I love this city. The 6. All right, low interest rates not expected to have the same impact. Okay, here's another interesting point, and I learned something. It's always good when I'm learning something. I know when I'm learning it, you're learning it. Here we go. During past recessions, lowering interest rates helped to stabilize real estate markets, of course. This is expected to have a smaller impact this time, since rates were already very low. So I did know that. So I knew that rates coming down isn't going to stimulate, because the reason things are not moving is because things just shut off. Like, we just shut it off. So you're not stimulating someone. It's like if you all of a sudden make it cheaper for someone to go buy a house, they're not going to change. Like, that decision was already made by the fact that you kind of close the industry. Or otherwise, like any purchase you're going to make. You're going to buy a car. I'm not buying a car because the rates are high on my financing. I'm not buying a car because I don't need to drive. So like that's how I've always seen it. But they make a really good point here. Listen to this. And I actually think this point's stronger than that one that I made. Listen to this. 5-year mortgage rates only declined 17 BPS, which is basis points, from the beginning of the pandemic to now. Okay? If you think about it, where rates were on your standard 5-year mortgage to now, they've only come down on average 17 basis points. But in contrast, the overnight rate has shed 150 basis points over the same period. So here's what's going on. We've seen this, but I haven't actually seen these numbers. So what's happened is the Bank of Canada is bringing down their rates. You guys have seen these drops. They did emergency rate drops, and just like kind of boom, everything just kind of hit the ground, right? But you notice that the mortgage rates, they didn't really come down all that much. In fact, in some cases, they went back up. And the reason for that is the risks, right? There's a lot of risks and whatever. So whatever the reasoning for that is, although the Bank of Canada is dropping rates, it has not had almost any impact on the applications for mortgages because rates are the same. Interesting point, right? So let's stop dropping interest rates to save our housing market because it's not going to do anything. But we're going to get to, there actually was a rate that HSBC's put out now, so we're going to talk about that shortly. But it wasn't because of this rate drop. It was actually because of what happened with the CMHC guidelines. So we'll get there. Hold your horses. Slow down, people. Too much of a rush for me. I'm trying to keep up. But I also got to slow down because I want to make sure you're understanding all of the words that are coming out of my mouth. Significant price declines not showing until the second half of the year. That's the key here, guys. We don't know where we are tomorrow, but we know today, and today is a good day. Today, things are doing pretty good. We're in this kind of equilibrium. We're in this nice little, maybe the eye of the storm. Ooh, I like that. We're in the eye of the storm. At least that's what some people, this is what these economists want to say, right? Whether we are or not, we'll see. But how do we really know? The call's up to you. What's going to happen over the next 12 months? I don't know. I know we have a buying opportunity right now. I know that. Okay, let's move on. Yesterday, as we were kind of talking about on a high level, all the big news that was kind of circulating around us, it was very difficult to get into any specific details. And I even missed this behemoth of a topic. Like, I completely missed it in my preparation for my podcast yesterday. Here it is. I'm going to give you the highlights, and then we're going to talk about it. There's a more recent article, because this news came out a few days ago. So there's been kind of more stuff emerging from it on how this will look, and we'll talk about it. So what we're talking about is commercial evictions, commercial rent evictions. Now, so here's the news. For June until the end of August, Ontario will ban the eviction of any small business that qualifies for the Canada Emergency Commercial Rent Assistance Program. First of all, thank you for making it only people who qualify for this program. Thank you, thank you, thank you, thank you. We said that last week when we were kind of doing our podcast, that's what Vancouver was doing. That is the right way to do it. Okay, if you're going to do this, don't do it for everybody. Do it for the people, because it's really not a strategy to try and stop all evictions. It's a strategy to try and get people to apply for this assistance program. And so by applying it to only these people, they did that. So I'm so thankful that that's the approach that they took, because we would have had ourselves a serious backlash, because some provinces have gone all the way. The move was announced on Monday by Doug Ford. Today's Wednesday, so there you go, 2 days ago, as part of a phase 2 reopening. And in other articles, I can see that the ban will take effect from June 3rd until August 31st. So we're talking 2 months. We're talking currently now. So wherever the cards are now, they're going to stay there. Whatever we got today is going to stay. It's got a good ring to it as well. But even though they've kind of just talked about this, we've known about this for 2-3 months. Like, we've since almost, I don't know, let's say at least a month and a half ago, we were talking about this, because even before this emergency assistance program was rolled out, they were talking about it coming. So yes, maybe we're, a month into this program. I think it was, what's the date on that? The 15th? Something like that. Program went into effect May 25th. Okay, but we knew about that at least a month before. I know we were talking about at least a month before. But here's the thing that happened, right? It rolled out on May 25th. Everyone kind of knew about it, but it's a very unclear program. But they only received 16,000 tenant applications over a potential of 1.2 million small and medium-sized businesses. So nobody cared. Nobody applied for this program. Nobody cared. There was threats that were coming from the premier constantly. Nobody cared, right? The reason he did it, by the way, was the pressure was too high, and he's really following others. For example, BC, Alberta, Saskatchewan, Quebec, New Brunswick, and Nova Scotia started one in March. So we are not first on this one. In fact, we're pretty much last. We're pretty much last. If there's another province in there, they're obviously not important in my mind. So there you go. So now all of a sudden we're following suit. Also, there's been a ton of people lobbying. Like there's been a incredible amount of lobbying. Even the mayor of Toronto had strong words to protecting small businesses at the cost of landlords. And so when they say, okay, it's like, oh, now it's an even playing field. You help the little guy. You know what you did? All you did was you switched it. You've completely flipped it. You gave all the power to the tenant for these guys, right? For the ones that would apply for this program. And some of them, you could argue, you know what? Too little, too late, right? Like we've had problems. We are in month 4 of the emergency benefit, and now you're rolling this out. So there's a joke in there as well as really, come on. John Shell, remember this name, Save Small Business, an upstart advocacy group, carries this article for the rest of the way here. There's 50,000 members in their program, and they said eviction bans are inevitable. All right, John, here we go. It levels the playing field. There had to be a mechanism to force landlords to take CECRA seriously. So Ford said, I'll always protect the little guy. You guys know there's we were getting over the last 2 months from Shell's group, from the Canadian Federation of Independent Business, Restaurants Canada, Retail Council of Canada, Toronto Mayor. There's been tons and tons of pressure, which is why even a week ago, we pretty much all but guaranteed this program was going to happen. The threats were happening daily from Ford. So here it is. But now let's look at what has been the impact, because luckily, because we're coming a little late, we can kind of look at how this has been impacting people. So here it is, Courtney Anderson. This Courtney's a dude. He owns Lucky's Corner 2, a Caribbean restaurant in Ajax. While his landlord has applied for CECRA, they really got to shorten that name, Anderson had to borrow money from family to cover his 25% of rent. So even though he's getting it, he's still got to borrow that money because he's making obviously nothing. So it doesn't work for everybody. Here's another example. Here's a landlord, Susan Chu, has 5 commercial properties and 30 tenants who qualify for the program. She's afraid of losing income and has already started the application process for 10 tenants. So she's obviously using it, but Chu has said she finds eviction ban puzzling. There's no one to move in. It doesn't make business sense for a landlord to evict a tenant. So this is the thing, guys. The way I kind of imagine is, think of it this. You've just opened up the emergency benefit, okay? So now you can qualify to get this money. Now, if Canadians were saying, a huge majority all of a sudden said, I don't want that. I don't want to collect that emergency benefit. I know it's more money in my pocket, but it's not worth it. I don't trust the program. I don't trust the government. I don't trust how it's set up. All of these things, I don't want it. And then all of a sudden the government turned around and said, well, you have to. It's now mandatory because we need you to use this program. What a weird thing. I get that you're trying to help, but maybe there's a reason that people didn't care about the money. Maybe it's not about the money for them. And so I think it's important that we kind of hash this out. Now, whatever their reasoning for it is, I think I've narrowed it down in this article. There's a few points. I think the big thing is it's confusing, and it gives way too much information. It tips off a lot of the banks that they're using. It causes more problems than money, right? It's not just about money, especially when you're a wealthy person who has multiple commercial properties. There's a rule of the world that says that when you own real estate, you're guaranteed a fixed level of income from it. There's no rule. There's no rule. There's no guarantee. There's no such thing as guaranteed money, even in real estate, right? I mean, even on the residential side, you guys are seeing this. Airbnbs, you're seeing it. That's why we need rainy day funds. With businesses closing down, rent will be less as well at the end of this. Oh, this is my point. This is something I wanted to say. Here's a point here as well. If you're going to kick them out, or you're going to pretty much evict them, you're going to remove them, you're going to come out on the tail end of this with at least a million other businesses that are at risk, at least, of doing this. So let's call it hundreds of thousands on the street businesses or gone businesses. Your industry as a landlord has now changed. So you don't think that your rents are going to come down because your competition is going to be so much higher, right? The demand is so much lower than the supply. So of course your rents are going to be lower. So there has to be a good reason for wanting to kick these guys out. Maybe they don't even want to kick them out, right? Maybe they just didn't want to apply for the program. Did we ever think about that? I'd be interested to hear if there's a story like that where people are like, you know what? They're not paying rent. I'm not evicting them, but I'm letting them say, I'll bet you there's a ton of stories like that aren't hitting the headlines. Okay, so here's some of the reasons, or here's some of the additional things that'll happen and some of the reasons. So Ottawa needs to move fast to make the application process quicker. So from what I'm hearing here, it's unnecessarily complicated to apply for this program. You guys know this emergency benefit program, super easy. to the point now where they are threatening people for jail time or fines for misuse of this program, right? Like they made it so easy. Well, that's not the same case here. And so applying for this program has been a little gruesome. So they said they should be working to prioritize ease of application over potential fraud. And they've done it the other way. So they're trying to limit fraud, and in exchange, people are finding it's too difficult, and so they're not applying. Shell said the federal government signaled in March there'd be another element of rent relief. This is the thing too. They were helping small businesses and medium businesses, but what about some of the larger businesses? There was an expectation there'd be a secondary rent relief program for medium-sized businesses that had lost between 30 and 70% of revenue. Guys, we are 4 months in to COVID. We are reopening, and what and like the promises of having more rent relief coming. Like, where are we in in this whole thing? Like, should this not have been done a month ago? Like, these programs are taking too long. They're not working. Like, I don't like to be overly critical, but I mean, I don't think it takes, any boob could see, is that offensive to say any boob? Any boob can see these programs are not working, right? And so strong arming people, is that the method? Well, that's the one that's being taken. He said cash grants should be flowing as part of a reopening strategy for the businesses that have survived. He's talking about Ford, but still need a boost in order to get them over the hump. So other provinces have had grants in place, and they're saying we need more grants. So here's the thing. Get your money in your hand. Are we allowed using paper money anymore, or just credit cards? And make it rain. Make it rain those credit cards. Make it rain those credit cards. I know you guys got a bunch of credit cards because this is Canada. Our personal debt is so high. Anyways, okay. Woo. Bringing it back. Bringing it back. Oh, fun lightheartedness. So you know how I said that they're going to apply jail time? Is that going to happen? Probably not. NDP already said they're not going to support it, so it's likely a wash. But there was a tweet that came. Who tweets? I don't tweet. Do you guys tweet? Who tweets? So this person said, I already got a call this morning threatening me with jail time about my use of my SIN number, and I am not receiving the CERB. Great work, everyone. And then Adam Vaughan, MP, said, that phone call was a scam, but it only works because the threatening words are government used. I do not and will not support jailing people for CERB unless they sign up horses with fake SIN numbers and live in Oklahoma. So there's a lot of backlash on that statement. I don't think it's going to roll out. Definitely not as it is. Will the CRA have something to say about it next year? Yes, almost certainly. But are you going to jail Canadians for that? Come on. We're already in jail. We're all on house arrest right now. Alrighty. Okay, let's go into our last topic here. Some very interesting points as it relates to CMHC. Okay? Now, you guys probably have heard the news, at least we mentioned it yesterday, that as of July 1st, home buyers are going to be in a bit of a crunch because the lending measures are going to get a bit harder. We talked about some of those. The pretty much this is the Coles notes. Minimum credit has bumped up from 600 to 680. Your maximum debt service ratio is now 44, and your gross debt service ratio is 35. So it's gotten a little bit harder, and it could mean thousands, if not tens of thousands, less in qualifying amount when you go to apply for a mortgage. So they interviewed this guy, Ron Butler. They're from Butler Mortgage, a huge mortgage brokerage, by the way, like a massive one, maybe the largest in the GTA. They're huge, and so they're often on these interviews, and this was with Yahoo Finance. So he said whenever there's been a deadline given for a major mortgage rule change, and they talk about how there has been a distinctly accelerated pace of transactions prior to that change. So the point, this is an interesting one, because they didn't just say as of today the guidelines changed. They've planted a day on July 1st, Canada Day, coincidentally. So because of that, we have this window now, which is that's actually a good point, right? So how is that going to impact things? So they give this example of a family, right? They've been working, they qualified for a $900,000 mortgage before the measures. Now they qualify for $790,000, losing about 12% of their purchasing power. Here's what they said. These are people that have been saving over time, don't have an income interruption, and don't perceive an interruption in their income. The credit scores are already fine. They're being told for no reason other than underwriting rules that they no longer qualify for what they want. Well, that's collateral damage in my opinion. Don't feel so bad for this family, but the timing is peculiar. And so if you're in this pickle, could this family maybe speed their process up? I find that super interesting. In the short term, what they're kind of alluding to in this article is there will be a scramble to be approved for a mortgage or purchase a home in a tightening window, and it'll actually boost sales to listing ratios, right? So in the short term, forget Q3, Q4, but in the short term, you are putting additional pressure on demand. Like, it is time to get that winning offer now. We can't afford to keep losing these offers because you're not going to qualify for that mortgage if we don't close this sucker before July 1st. An interesting point, very valid point. Maybe it was a fall through in the thinking, but when we're even looking at the CMHC, this is what Evan Siddall had to say, because there's this kind of conflict that's happening right now, and I'm going to read you a hilarious quote in a second. But what he said, the reasons for this tightening measures at such a weird time is to, quote, protect homebuyers, reduce government and taxpayer risk, and support the stability of housing markets while curtailing excessive demand and unsustainable house price growth. But check this out. Okay, here we come. Ben Rabideau, president of North Cove Advisors, doesn't agree with the, quote, free market characterization of the mortgage market. Listen to this. Also a good point. We got some good articles today. We're having fun. Here's what it says. The entire mortgage lobby has a direct federal guarantee and multiple layers of direct federal guarantees that subsidize them. So cry me a friggin' river. That's such a good point. He's right. Like, he is right. There's a reason. So the mortgages, by the way, that are affected are a type of mortgage called insured mortgages. That should be your first clue, okay? This only applies to insured mortgages. Well, what is an insured mortgage? Let's explain how this works. If you put more than 20% down, CMHC already insures it. It's considered a non-insured product. Not because there's not insurance, but because it's already protected. They only protect up to that amount. If you're going to put less than 20%, you yourself have to pay this thing called CMHC insurance to pay that premium for that portion of the insurance, okay? So these are the insurance products. These are the ones that you're paying that premium for. But this is the point. You're paying a premium to insure a product, right? According to Rate Hub, mortgage default insurance, commonly referred to as CMHC, protects the lender in the case the borrower defaults on the mortgage. So when you're paying this insurance, you're not even protecting yourself. You're protecting the guy giving you the money. I always find that really funny. You're paying the legal fees for the lender. You know, you're always the one paying it out. Like in a mortgage situation, you're at the mercy of the lender. You're at the mercy of, and this is one example of that. Same with why you should never get mortgage insurance. Never, ever, ever get mortgage insurance, guys. Get life or get term insurance. Just cover your life of your mortgage. That's it. Okay. But that's right. Like they're already protected, and yet here we are tightening things in order to protect them. Like, that's such a good point. Cry me a friggin' river. So Butler, the mortgage broker we talked about earlier, noted that the soaring household debt levels, much of which is driven by mortgage debt, are a factor. At the end of the day, an insurance company has to wisely consider how to operate their business. And that's what they did, right? CMHC has done it. But here is a way that it is now affecting us directly, okay? Almost immediately after this happened, HSBC introduced a record low 1.99% rate on a 5-year fixed mortgage. It was the first bank to break the 2% barrier on a 5-year fixed, according to RateSpy. So rates are starting to come down because of this. Okay. Now, maybe it's because the risks are going down. Maybe that was the move all along. Maybe. I don't know if I agree with it, but maybe the move was make it a little more difficult, lower the risks, and therefore bring down our rates and therefore increase prices. I don't know. All I know is right now you can get a 5-year fixed mortgage from HSBC at 1.99% before the end of June. You can make sure you've got a home office, buy yourself something pretty, get a little pool in the backyard for the kids, you know. Just make sure you don't have neighbors that insist on hugging you until after the pandemic. Bloody neighbors. But there is so much going on, guys. I hope you guys learned some stuff. These are some of the deets. Now you're all cool. Some of the deets. These are the deets, fam. So we're having some fun here. I hope you guys learned some stuff. Leave us a comment down below if you got any topics, some stuff maybe we've missed. I think we're caught up, at least from the last few days. So tomorrow we'll have some more news for you. By the way, I think daycares are opening if you got kids, so that's good news too. There's so much going on in our world. There's so much going on in our city. It's a beautiful city at that. Today's a beautiful day. Make sure you practice social distancing. And I will see you guys tomorrow morning with more. Take care and keep it real.